Audit and assurance. In previous lecture, we started third area of our syllabus, audit planning and audit risk. I hope you guys have covered the previous lecture properly, thoroughly. On audit risk, we covered one question in previous lecture, that was papaya. I hope you people have covered that question.
Yes, sir.
Papaya. Yes. So let's move towards another question on audit risk. We're gonna just practice some question on audit risk, 2-3 good question today. So let's move toward this question, Bluebell. Towards the requirement of the question. The requirement of the question for 14 good marks. Using the specific information provided, identify and explain risk of material misstatement. We need to identify and explain the risk of material misstatement to be addressed when planning the final audit of Bluebell Company for the year ended 30th November 20x8 and the company year end is 30th November 20x8. So we need to identify and explain risk of material misstatement the similar way that we covered the papaya question. Whatever the issue we are identifying, we'll put a heading of that issue. If there is any accounting standard involved, we will discuss the accounting standard treatment, and we will discuss what could be the chance of misstatement if company do not comply with that standard. So 14 marks, this means 7 good risk relating to accounting standard we need to discuss. If there is any risk where no accounting standard is involved, that we can discuss for 1 mark. And the issue where any accounting standard is involved, that will be for 2 marks. So risk of material misstatement we need to identify and discuss. So put a heading risk of material misstatement. Bluebell Company operates a chain of 95 luxury hotels. This year's results show a return to profitability for the company following several years of losses. From past few years, company was incurring losses, but this year they have moved towards profitability. There could be chances current year could be loss as well due to manipulation result. They have shown the profit. Let's see. Hotel trade journals show that on average revenue in the industry has increased by around 20% this year. Okay, if industry average revenue has increased by 20%, there could be chances they have also increased their revenue and they have moved their business from losses to profitability. So despite improved profitability, Bluebell Company has poor liquidity. Still, they are struggling in managing cash flow. And is currently trying to secure further long-term finance, and the company is seeking long-term finance. Mean they need money either through equity or either through debt. And if you want money through equity or debt, ultimately you need to meet certain conditions. And conditions could be relating to financial statement results. And if those conditions are not fulfilled, there are chances company could manipulate the results. And might be the current year profit is due to that manipulation. So we can discuss this risk, but let's see. Might be we can find 7 good risk relating to standards. If we are unable to find 14 marks risk properly, then we can discuss this. I'm leaving this right now. There could be chances of manipulation because if companies are moving towards seeking finance either through equity or debt, so there could be some financial conditions, financial targets, fulfillment conditions might be there. And if companies are not meeting those conditions, chances of manipulation in the financial statement. So you have been the manager responsible for the audit of Bluebell Company for the last 4 years. Extract from the draft financial statements for the year ended 30th November 20x8 are shown below. Revenue. If we look at the revenue, previous year revenue was 713. In current year, it has increased from 713 to 890. Can you calculate revenue growth for the company, sale growth for the company? Current minus previous over previous multiplied by 100.
19.68%.
I think so. It's a 24.8%.
So today
890 minus 713 over 713 multiplied by 100. It's showing 24.8.
24.82.
25%, nearly about 25%, while industry average is what? 20%. So company revenue growth is more than the industry average. And there is a note 1 relating to this. Note 1 saying, revenue comprises sale of hotel rooms, conference and meeting rooms. Revenue is recognized when a room is occupied. A 20% deposit is taken when the room is booked. This is what advanced revenue. There could be chances company recognizing this 20% advance revenue as a revenue rather than deferred income as per IFRS 15. In this 20% deposit, advance revenue should be recorded as deferred income, deferred revenue per IFRS 15 because the performance obligation is not arised yet, is not performed yet. So there could be chances revenue overstated if company is not recognizing this 20% advance revenue as a deferred income. So first we can discuss the analytical procedure. Analytical procedure means industry average is 20% while company revenue growth is 25%, which is far above than the industry average. And per IFRS 15, the advance received from the customer before occupying the room should be recorded as deferred income rather than income. And there could be chances if company recording this 20% advance as a revenue, so revenue could be overstated. So we'll put a heading revenue. And under revenue, we will discuss these 3 points. One, analytical procedure, percentage, then IFRS 15 criteria regarding this advance revenue, and then what could be the chance of misstatement in financial statement. So for 2 marks, we have discussed one risk. Operating income has increased from 690 to 835, and operating expenses, sorry, increased from 690 to 835, and there is a note 2 relating to this. So let's move towards the note 2. Significant item included in operating expenses, share-based payment expense. In previous year, it was nothing. In current year, it is 138. Share-based payment. Is there any accounting standard on share-based payment? IFRS 2. Regarding this paper, AAA, we should keep some points relating to these standards. We will always discuss only 3 points relating to this standard for this paper only. From accounting point of view, ultimately, we should know about the calculation, of the other information as well. But for this paper point of view, we should keep in mind 3 points relating to this standard. First point, all calculation of share-based payment must be based on fair value of a share at grant date. So calculation should be based on fair value of shares at grant date rather than any vesting date. Because the share value could be different at the start, could be different during the tenure could be different at the vesting period, but all calculations should be based on the fair value of shares. Fair value means market value of shares at grant date. So there could be chances if the calculation is not based on fair value of shares at grant date. Might be they have calculated value based on value of shares at vesting date. So there could be chances of manipulation. Second, normally these share-based payments are for a long time period, more than 1 year. And if it is on more than 1 year, it is not possible always like all option will vest. There could be chances of staff turnover. That's why staff turnover should be incorporated into the calculation. Staff turnover should be incorporated into calculation. And third point, there must be a disclosure in the financial statement regarding share-based payment. Only these points we should remember while attempting this paper, triple A. Calculation of share-based payment should be based on fair value of shares at grant date. Staff turnover must be incorporated into the calculation, and there should be a detailed disclosure in the financial statements about share-based payment. So let's see. There is share-based payment expense recorded 138 in current year, and there is note 1. In June 20x8, year end is 30th November 20x8. So during the year. In June 20x8, Bluebell Company granted 50 million share option to executive and employees of the company. The cost of the share option scheme is being recognized over the 3-year vesting period of the scheme. It is currently assumed that all of the option will vest in, they are assuming 0% staff turnover. While in 3 years time period, it is not realistic that staff turnover will remain 0%. So all of the option will vest and expense is calculated on that basis. They haven't incorporated staff turnover. Bluebell Company operates in a tax jurisdiction in which no deferred tax consequences arises from share-based payment expense. Even we don't need to discuss about the deferred tax consequences. So we'll put a heading share-based payment. And we will discuss the criteria per IFRS 2. The calculation of share-based payment should be made on the fair value of shares at grant date. And staff turnover must be incorporated into the calculation. And there are chances if the calculation is based on 0% staff turnover, which is unrealistic for 3 years, chances of manipulation in financial statement. Then we discuss this for 2 marks. Okay. Next, there is another expense, damage property repair expense of 100. In previous year, it was nothing. Damage property repair expense, meaning expenses, operating expenses, it is included 100. In September 20x8, during the year, 3 hotels situated near a major river were severely damaged by a flood. All of the hotels which were constructed by Bluebell Company only 2 years ago need extensive repairs and refurbishment at an estimated cost of 100 million. The refurbishment cost, if incurred to enhance productive capacity of the asset, should be capitalized per IAS 16. And if these costs meeting capitalization criteria, and company is expensing out because it is recorded as expense, chances that asset profit could be understated and expenses overstated, which has been provided in full. Very important. Which has been provided in full. What does that mean? Which has been provided in full mean company has recorded provision for that. Which has been provided in full. Provided in full mean company have provided me, company have recorded provision for these expenses. Expense debit, provision liability credit. If we discuss about IAS 37 provision, must be recorded by meeting three conditions. Present legal constructive obligation from past event. If we see there is no obligation. Probability of future economic outflow is there. Amounts can be measured liably, it's there, but it's not obligation for IAS 37 that a company could record as provision. So if company have recorded provision for this, it is not meeting the criteria of provision for IAS 37. In that case, expenses, liabilities could be overstated. Is that? All of the buildings are insured for damage caused by flooding. The buildings are insured. And if company can recover these costs from insurance company, even this is not the expense of the company. If you have bear this expense in the year, but you can recover this from insurance company after the year end, then for IAS 37, it is meeting condition of contingent asset. Then in that case, contingent asset should have been disclosed. So we'll put the heading what? Damage property repair expense. And we'll discuss per IAS 37. Provision should have been recognized if there is a present legal constructive obligation from past event. And this damage to the property does not meet the criteria of a present legal or constructive obligation. And if without meeting criteria, company have recorded as provision, chances that expenses, liabilities could be overstated and profit understated. Then we will discuss these buildings were insured. This means this is not the expense of the company. Company should not record this as an expense because this expense should be borne by the insurance company. But if company have paid for these expenses and company will be able to recover these expense after year end, then it is a meeting condition of contingent asset per IAS 37. It should be disclosed. If there is no disclosure, financial statement could be manipulated. So these two things we will discuss, one about provision and one about contingent asset. And what's the issue? What's the accounting standard involved? And what could be the chance of misstatement? Chance of misstatement. We are not saying these are misstated. We are at the planning stage. We are highlighting risky areas. Could be overstated, could be manipulated. So let's move forward. We have discussed 3 risks from these 2 areas. 6 marks we have covered out of 14. We are adopting an approach how to tackle audit risk question, how to get good marks. So other operating income, last year it was 10, current year it is 135, mean there is increase of 125. And there is note 3. So let's move towards note 3. Other operating income includes profit on property disposal. In company dispose of one of the property during the year, and this 125 increase is relating to profit on disposal. Obviously, if company is disposing any of the asset, that income we should record as separate other income. Okay, there is detail. 8 properties were sold in March 20x8 to Daffodil Fund Enterprise. Daffodil Fund Enterprise. Okay. Bluebell Company entered into a management contract. Management contract. It's not a sale contract, it's a management contract. Okay. What is a management contract? I mean, there could be some different arrangement rather than sale only. With the DFE and is continuing to operate the 8 hotels. Okay, if you have sold, then how you can continue? Under a 15 years agreement. Okay. 15 years agreement. Sale and lease back. There's indication of sale and lease back. Under the term of the management contract, Bluebell Company receive an annual financial return based on the profit made by the 8 hotels. Mean the risk and reward relating to the hotels will remain with you. You will be enjoying all the benefit of the buildings. Mean who is enjoying the benefit of the building? You. If you have sold, then how you can enjoy the benefit? At the end of the contract, Bluebell Company has the option to repurchase the hotel, and it is likely that the option will exercise. This means this is not a sale. This is sale and lease back option. Is there any standard on sale and lease back?
Yes, 90.
IFRS 16 leases. According to IFRS 16 leases, what is accounting to record sale and lease back? First, you should record the sale. How? Debit cash, whatever you have received. Credit your asset, you need to remove. And whatever the gain you are getting, that gain should not be recorded as gain. It should be recorded as a deferred income and amortized over the lease period. It should be amortized over lease period. And what this company have recorded? They have recorded the complete gain in the current year. In that case, profit could be overstated. Liabilities, understated. Amortized deferred income should be recorded as a liability. And if you haven't recorded as deferred income, you have recorded as income gain. So in that case, profit could be overstated and liabilities understated. After that, you need to record the asset again against lease liability. Sorry, asset debit with the new amount, credit lease liability. And if you have just eliminated the asset, what they have done? They have recorded cash. They have recorded reduced the asset, and this they have recorded profit. This means this transaction is missing. In that case, assets liabilities could also be understated. If you haven't recorded the asset, this means you haven't recorded the depreciation as well. If you haven't recorded the lease liability, this means finance cost is also missing. In that case, expenses could be understated and profit overstated. Is that? Mean first you need to record the sale accounting entry that they have recorded, but the gain on disposal should not be recorded as a gain complete in this year. This should be recorded as deferred income and amortized over the lease period for IFRS 16. And then company have to record the asset with the new amount against lease liability, which is not recorded here. So chances that asset liabilities could be understated, asset liabilities expenses could be understated, and profit overstated. That we can discuss under the heading, what is that? Other operating income. We'll put the heading other operating income for IFRS 16 leases. We'll discuss. We are adopting an approach how to discuss different kind of issues using the knowledge of standards and how we can link with the chance of misstatement. Okay, so 4 good risk we have identified so far. Let's move forward. If we move back towards the P&L, so we have discussed revenue, we have discussed operating expenses, we have discussed other income. So then there is operating profit given. Previously it was 33, now it is 190. And if we see the current year profit might be not be a profit. Because if we deduct this 125, it will be having huge impact on the 190. Even the revenue, the 20% if you record it as revenue, having huge impact on the 190 profit, mean there are chances current year companies also suffering a loss. Finance charge. Previous year it was a 43, current year it is 45. 43, 45. Is there any information about this? So let's leave this. Even there is not a huge change. And then profit or loss, and current year company is showing 145 profit, but based on the above issue, there are chances current year companies also suffering a loss. So move forward. Now we are having balance sheet data. Property, plant and equipment figure previous year was 1135. Current year it is 1265. Reduced. And the reduction could be due to the asset on sale and lease back not recorded, because they just removed the asset. They haven't recorded the asset again. But there is a note for property, plant and equipment. On 31st October 20XA, during the year, all of the Bluebell companies owned hotels were revalued. Revaluation. Is there any accounting standard? IAS 16. Company can record their asset either on historical cost basis or revaluation basis. If you have adopted revaluation policies, all assets in the same class should be revalued. No selective revaluation is allowed. It's not like that you can choose where we are having gain, we can move towards devaluation, where we are having losses, leave it on cost basis. No, if you have adopted revaluation, all assets in the same class should be revalued. And assets should be depreciated over the revalued amount. Some company are having a different logic, as there is revaluation gain. Asset value has gone up, so there is no need for recording depreciation and amortization. Impairment, no. Depreciation, impairment, that is different. Revaluation is different. If there is a gain, depreciation should be recorded on the revalued amount, not on the previous amount, based on the remaining useful life. And revaluation gain should be charged to OCI, and losses should be charged to P&L. Is that? A revaluation gain of 250 million has been recognized in statement of changes in equity and in the statement of financial position. So they have recorded 250 million revaluation gain. Obviously, gain should be charged to OCI. OCI, ultimately statement of changes in equity under revaluation surplus. OCI, other companies' income recorded after P&L, as well as in statement of changes in equity, there is a revaluation surplus column. Share capital, share premium, retained earning, and revaluation surplus. So ultimately, we need to record where in statement of changes in equity, and they have recorded in statement of changes in equity. Okay, 250 million. 250 million revenue they have recorded. Is there any other information? If we look at the balance sheet data, property, plant and equipment, deferred tax asset, deferred tax liability, if there is 250 million gain, in that case, assets should be added by 250 million. Is that? While if we look at the asset, their value has decreased as compared to previous year. No, increase. Their value has increased as well. And if you look at the asset value, its value is increased by how much? 1265 minus 1135? 130. And the company have disposed some of the assets. that they recorded as disposal rather than sale and leaseback. This means that asset was not re-recognized. So there could be chances company charging revaluation losses to OCI to revaluation surplus. Or there could be chances the asset is not depreciated over the revalued amount. In that case, financial statement could be manipulated. So first we will put a heading revaluation. PPE. So for IAS 16, if company is moving towards revaluation policy, all assets in the same class should be revalued and assets should be depreciated over the revalued amount, as well as revaluation gain should be charged to OCI and losses should be charged to P&L. So there could be chances if asset is not depreciated over the revalued amount, or losses also adjusted against revaluation surplus, financial statement could be manipulated. Or 2 marks we can discuss. Okay, if we move forward, there is deferred tax asset. Previous year it was 335, current year it is 285. Is there any standard on deferred tax asset? IAS 12. The name is income tax, not deferred tax. Income tax. For this paper point of view, you should remember only 2 points for IAS 12. First, all tax calculation should be based on the current rate. On tax calculation should be based on current rate rather than any historical rate or future rate. All tax calculation should be based on the current tax rate. And deferred tax asset, there is criteria for recognizing deferred tax asset. Deferred tax asset can only be recognized if there is a chance of, there is a probability of future profit, future benefits. If chances of future profit. If there is no chance of future profit, because this deferred tax asset is what? We need to recover this from HMRC. We cannot ask this deferred tax asset is based on previous tax year losses. If we are incurring previous tax year losses, obviously there was no tax liability, because tax liability will arise when we are having profit. So previous year losses, this means in case of loss, we can recover from HMRC. But we cannot recover amount from HMRC. This recoverability we can adjust with the future liability. Future liability will arise if there will be future profit. If there is now no chances of future profit, this means we cannot recover this. If we cannot recover this, ultimately we cannot recognize deferred tax asset. Is that? If you see this company, though they are showing current year profit of 145, but based on the above issues, if we see there are chances companies incurring loss for the current year, and if companies recognizing deferred tax asset without meeting the criteria of future profitability, chances that assets could be overstated. So we'll put the heading what? Deferred tax asset. And we will discuss per IAS 12. All tax calculation should be based on the current rate rather than historical or future rate, anticipated rate. And deferred tax asset should only be recognized if there are chances of future profitability. And based on the above issues, there could be chance company incurring loss for the current year as well. And if company recognizing deferred tax asset without meeting the criteria, chances that asset could be overstated. 2 marks. We are adopting an approach regarding what standard we should discuss what point and how we can link with the chance of misstatement. Okay, let's move forward. There is another deferred tax liability given. Previous year it was 638, current year 735. And there is note 6. Okay, note 6. There is information about deferred tax asset. Let's see it. The deferred tax asset represent unutilized tax losses which accumulated in the loss-making periods from previous 2004 to 2007. Inclusive. Bluebell company is confident that future taxable trading profit will be generated in order for the tax losses to be utilized. But we cannot see they can generate future profit. So deferred tax liability. How this 735 is calculated. The opening balance was 638. That is coming from previous year. Yes, 638. Charge to equity 88. And charge to tax expense 9. What is this 9? This is current year tax expense. Which is calculated on profit before tax. Is that? If you look at company profit before tax, is that given in the question? This means that 9 has been calculated on this 145. Is that? That 9 is calculated on this 145. Put a heading deferred tax liability. This 9 has been calculated on 145. If we multiply by 100, we can find the tax rate. Can you find the tax rate? How much is that? 9 over 145 multiplied by 100. 6.2%. Means this tax has been calculated on 6.2% tax rate for a company. You people have learned corporation tax in taxation paper. What is the tax rate normally for a company? 90. It could be 20% above, 25, 30%. 25 to 30%. Is it possible for a company who's having 95 luxury hotels and their tax rate is a 6.2%? No, this is unrealistic. This means company understating the tax expense to highlight profit after tax. Why companies are highlighting profit after tax? What's the purpose company can achieve to highlight profit after tax? Have you heard about the EPS, earning per share? How earning per share is calculated? Profit after tax divided by weighted average number of shares. Mean numerator, if you overstate, ultimately earning per share will be more. More earning per share will attract more investors. That company want to do. They want to seek more finance. If through equity, how they can attract investor through equity by showing high earning per share. So this is the reason company trying to understate tax expense and profit after tax as well as earning per share could be overstated. And if you link this with earning per share, might be your examiner will give you certificate. So can we discuss this? What we have done this, we have performed analytical procedure. Plausible relationship. Plausible relationship. The plausible relationship, we found what tax rate that company have applied to calculate this 9 tax for the current year. And it's showing 6.2%, which is unrealistic for a company. It should be near about 25-30%. So there could be chances company understating the tax expense as well as tax liability. Because what's the accounting entry for tax? Tax expense debit, tax liability credit. And company overstating what? Profit after tax as well as earning per share to attract the investor to seek more finance. Can we discuss this? How many risks we have discussed? 1, revenue. 2, share-based payment. 3, damaged property. 4th, sale and lease back. 5th, revaluation. 6, deferred tax. And 7, how many marks were there? 3 marks we have done this. So we have adopted an approach how to tackle risk question. Haven't adopted approach. We are still learning. After practicing 4 or 5 good questions, we'll be able to adopt proper approach, how to tackle risk question, how to gain good marks in risk question. So part A for 14 marks done. Now moving towards part B, that will decide pass and failure of your paper, where students are struggling. Procedure and evidence. Examiner asks about procedure. What student doing? They are writing evidence. And they are very confident after attempting the paper. Oh, we attempted the paper full. How we can fail? No, we cannot fail. If he is asking about evidence, what they are doing? They are stating procedure over there. They are not able to distinguish between procedures and evidence of wording. Procedure mean action. Evidence mean what you are having in your working paper after performing that action. Procedure mean inspection, observation, confirmation, discussion, inquiry. Compare this with this, discuss this with the management, review board minutes. For the evidence. After performing this procedure, what you are having in the working paper, name of documents, copies of documents, not the action. Don't say inspection of this document as evidence. No, this is procedure. Discuss with management. This is procedure. Notes of discussion with the management. And after discussion, what you have written down as a notes in your working paper. So that is evidence. Okay, so describe the principal audit procedures to be carried out in respect of the following for 6 marks. We need to write down procedure relating to the measurement of share-based payment expense. 6 procedures we need to write down to verify share-based payment expense measurement. 2, 3, maximum 4. Students are able to tackle. As the marks are moving above a 5, students are struggling because first 2, 3 procedures they can make easily. After 2, 3, mind stop working. They are totally clueless what to write down now. And for 6, we need to pass at least 3 good procedures should be there. Out of 6, how much you need to get for passing? 3. So there was issue in share-based payment expense. What the company was not recording, not incorporating staff turnover. So mainly 2, 3 procedures should be based on verifying this staff turnover. So first, we will write down what? Inspection of what? Share-based payment contract. With whom? With a staff member. What? To identify number of employees in what? Because employee multiplied by options, multiplied by staff turnover, amount divided by 3 years, then we will be able to verify the expense for the current year. So number of employees, number of options per employee, fair value of share at grant date, on which calculation is based, vesting period, whether it is 3 years or not, because after calculating the amount, we need to divide by 3. Then for the first year, second year, third year, expense we'll be able to find. So first we need to inspect the share-based payment contract copy to identify number of employees involved, number of options per employed, fair value of shares, vesting period, and grant date. Because the fair value of a share, we need to verify whether on grant date this was the value of shares. Is that? Next. What? Is that a decision is of company management level that they have discussed in their board meeting? Then always there should be review board minutes. 2. But verify how management considering the event and accounting for it to see if reasonable, because their discussion will give us an idea whether they are going to manipulate this, whether they are going to calculate this properly or not, to see if reasonable mean whether they are considering the event properly, they are accounting for it properly, mean if there is disclosure required, they are going to make a disclosure, they are performing calculation properly, if there is any accounting record, they are moving towards correct accounting. Through their discussion, will be able to identify whether they are treating the event appropriately. What else? They have calculated based on all option will vest. They haven't incorporated staff turnover. So discuss with management. The reason behind 0% staff turnover. To see if reasonable, in whether they'll be able to satisfy us or not. But they are saying whether that thing is reasonable or not. Might be they are saying no, only we family members are working. How we can leave the company? We will still be there till our death. There are no external employees. Okay, that's fine. 0% staff turnover assumption is fine. But if external employees are working, anybody can leave. But still, will not be satisfied with the discussion only. We'll see past 3 years staff turnover. If in last 3 years there was some staff turnover, in coming 3 years there will be staff turnover. You can say in coming 3 years there will be no staff turnover, while in the past 3 years there was staff turnover. From where we can identify staff turnover last 3 years? Inspection of payroll records to verify staff turnover in last 3 years. Whether there was any or not, if there was any, how much was that? Because if they have recorded on 0% staff turnover, this means this amount is wrong. So what is the correct amount that we need to calculate? So recalculate the share-based payment expense based on staff turnover and compare with the management calculation for accuracy. See whether their amount is accurate or not. If not, how much is the difference, on which we will decide whether it is a material we should move towards qualifying audit report or not. How many we have discussed? 1, 2, 3, 4, 5. One more. One more. What we can discuss one more. Relating to measurement of share-based payment expense. What else we can discuss? Regarding staff turnover, can we verify anything else? Regarding staff turnover, if they have recorded share-based payment expense, there could be some payments during the year. There could be some payments during the year. How we can verify if they have made any payments? They not only have recorded the expense, they are paying as well. Through cash book bank statement. So inspection of cash book bank statement, verify any payments made to employees during the year. Can we confirm from the employees as well whether companies are having this kind of contract with them? Because if employee are not aware about this, or there could be chances that they are aware about a different options, company have recorded different options. Companies providing fake documents to us while in reality something is different. So we can confirm by discussion with the employees involved are allotted share-based payment. Allotted share-based payment. About the similar terms involved. Terms like how many employees involved, what are the options per employee. These are the terms relating to share-based payment, whether they are aware about the same terms. Is that? And what else we can say about similar, other than terms, what word we can use? About similar detail. Relating to share-based payment expense. It's not an easy to write down 6 procedures, because after 2 to 3, there is exam pressure. Mind stop working. But we're having good practice. If we're having good practice, we have practiced this share-based payment expense. By practicing this, at least we got some idea how we can discuss further points, what other things we can discuss. So through practice, we'll be able to tackle this part. So what you need to do, you need to write down these procedures at least 3 times. Try to write down these procedures during class when I'm discussing, just to keep in mind. And then at home after the class, and then during revision as well. Don't just cover this procedure part in mind only. It should be in written form. Please. There are about 20 to 25 marks in our paper. where examiner will ask about writing down procedures, writing down evidence. 20 to 25 marks. And these 20 to 25 marks will decide your pass or failure. Risk question everybody can tackle. Everybody can discuss, oh, this is standard involved. Okay, this standard we need to discuss, and this could be a chance of overstatement, understatement. Ethics question, everybody can tackle. Oh, okay, these are the professional issues, these are the ethical issues. Audit report, anybody can tackle. Okay, this could be type of report. But this is the area where students are struggling because this is totally practical area. If you are working as an auditor in practice in any of the firm, then you can tackle this area a little bit in easier way. But as we are not working as auditor in practical field, and what your examiner is expecting, you are the auditor. You are the auditor. To pass this paper, we should think like we are the auditor. Practice, written practice is very, very, very important in this paper. Every area is having some different approach to answer the question. There are some terminologies, there are some jargons that we need to use. If in risk question we are not discussing chance of misstatement, there will be no marks. In ethical and other professional issues, if we have just highlighted the issues, we haven't provided the mitigation, there will be no marks. And in this procedure evidence question, if we are unable to distinguish between the wording of procedure and evidence, we're losing marks. Part B2 are 4 marks. We need to write down 4 procedures. Okay, fair enough. 4 we can write down. Well, let's see. Regarding the recoverability of deferred tax asset, how you can verify company will be able to recover this deferred tax. Not to verify deferred tax asset. Recoverability of deferred tax asset. First, we can see the calculation regarding the amount, whether the amount is accurate or not, because if the amount is inaccurate, ultimately company will not be able to recover. So we can say inspection of deferred tax asset calculation. To verify accuracy. In this amount is accurate, because if the amount is inaccurate, how company can recover? Now, recoverability will be based on future profitability. How we can verify future probability of profit, chances of future profitability? So we can inspect our review, cash and profit projection, our forecast. Projection is long term, forecast is short term. Forecast means 12 years, projection is more than 12 months. So projection or forecast to verify future profit probability. What else? Discussing management. Regarding chances of future profitability, to see if reasonable mean their words, their lines are reasonable, realistic based or not. You will ask them, sir, how you can expect your future profitability? They will say, we have made this investment this year, so we are expecting we will be able to get good return within 2 to 3 months. Okay, fair enough. We have signed a good deal with the large customer, and this will provide us a huge cash inflow in coming 2 to 3 months. Okay, fair enough. But if they are saying, oh, we have started a project that will complete after 3 years, and we are expecting we'll be able to get returns from that project after 2 to 3 months. If the project will complete after 3 years, how you can get return after 3 months? So to see if reasonable. What else? If company is trying to recover this from HMRC, ultimately there will be some correspondence with taxation authorities for recoverability. You need to inform them, na? You need to inform them like these were the previous year losses based. These are the previous year losses based tax calculation, so that we're gonna recover in future. So there should be some initial intimation to the tax authorities with the, yeah, you can see tax return as well. So inspection, review, tax return. The review of tax return copy to verify future tax liability arises, against which company will be able to recover this. Or we can say review correspondence with the tax authorities regarding recoverability of deferred tax asset against future tax liability. There could be some communication with them. Is that management level decision? Obviously, management have discussed with each other in the meeting, in board meeting, how we can recover this, mean how they are pursuing about future profitability. They will discuss with each other, because this is a huge amount going to be appear in financial statement. So ultimately, before approving the financial statement, there will be discussion on this matter, because without meeting standard criteria, they cannot recognize. If they have recognized this huge amount, ultimately there could be discussion between them how we can recover this, whether this should be recognized or not. So what we can do, review board minutes to what review board minutes to verify how management considering the account balance and its accounting to see if reasonable. See if reasonable. So part A for 14 marks, part B for 10 marks, 24 marks we have covered so far. There's a part C of the question as well. Again, very important for 12 very good marks. Required respond to the partner's email above. Okay. A new internal auditor, Daisy Ruspeter, has just joined Bluebell company. Who's Bluebell? Our client. So they have appointed their new internal auditor, Daisy. She has been asked by management to establish and to monitor a variety of social and environmental KPIs. Social and environmental KPIs. Moving towards one topic called integrated reporting. What is integrated reporting? A company should not only report the results of their financial transaction in the annual reports, they should report the impact of their transaction on the society and environment as well. Mean how you are impacting the society, how you are impacting the environment, you should provide a report on them as well. To provide a report means company should perform social and environmental responsibilities. Reporting doesn't mean you need to report. The main reason behind reporting is what? You should focus on social and environmental responsibilities. Company need to perform social and environmental responsibilities, and how you are performing social and environmental responsibilities, you need to prepare a report and present in the annual report along with financial statements. If company have decided moving towards integrated reporting, providing social and environmental responsibilities reporting, this means they have prepared their mind, we should perform social and environmental responsibilities. If company have decided we should perform social and environmental responsibilities, what they does, they set there some social targets and they set some environmental targets that they try to meet during the year. And at the end of year, they measure those targets, where they have met, where they haven't met, and if they haven't met, what steps they're gonna take in future. So they will prepare a report on that. These were the social targets. This we have met during the year. This we are unable to met, and we have adopted these steps so that we can improve in future. These social and environmental targets are called social and environmental KPIs. Social KPIs. KPI stands for key performance indicators. And environmental KPIs. Key performance indicators. This Bluebell company is doing what? They are running hotels. They're having 95 luxury hotels. What is meant by social responsibilities? Caring about the society. In society, who are in society? Your stakeholder. Social responsibility means showing some concern for the stakeholder. Your stakeholder could include your customer, your employees, your shareholders, even general public. What could be social KPIs for a hotel business? From employee point of view, we can say training of employees. Because if you train more to the employees, ultimately you are able to develop their knowledge more. Developing their knowledge more, you are giving them a chance to prosper in their career. What else could be social KPIs for hotel business? Other than training of employees. For our society, you can say fair employment opportunities. Equal employment opportunities for male, female, disabled quota as well. So equal employment opportunities. What else? Social KPIs. For employees, you can say good working environment. Good working environment also include providing them a good cafeteria, providing them good heating cooling system, providing them a good you can say quite free zone where they can relax during break hours, during vacant hours. So we can say what? Good environment, good working environment. Working environment means we have established a good canteen for the employees where they can have good hygienic food. We have provided them a facility of a gym during the work. Like after work, they can use that facility for maintaining their better health. We have provided them good heating and cooling system. For that, we have installed some of the air conditions in the working conditions, or if they are working outside and working during winter season, we have installed some heaters over there so that their health should not be affected regarding health and safety. So these could be relating to employees. What could be relating to customers? Our general public. Social KPIs. What could be social KPIs for hotel business? For hotel business, you can provide free meals to the society as a donations. Free meals for needy people, poor people. Like you are preparing food. If you are unable to sell the complete food in a day, the food that is left, you have provided free meals to the society, to the needy people, to the poor people. This is what social responsibility. What else could be social KPIs? You can say a donation charities. These are what social KPIs. What could be environmental KPIs for a hotel business? Obviously, CO2 emission is not relating to hotel because they're not producing something. This could be relating to manufacturing company. So recycling, we can say, in using recycled material is that where they can use the recycled material. In the room, the mattress, instead of new, they can use older mattress. Instead of using new pillows, blanket, they can use used pillow blanket. No, it's not like that. In food, they can use any recycled material. No, in food, they cannot use. In decoration, they can use recycled material. If you have noticed nowadays, the new restaurant, in their decor, they are using old tires, they are using old wooden pieces in their decoration. So in decor, they can use recycled material. What else could be environmental responsibilities for a hotel business? We can say energy saving. Energy saving. In moving towards more advanced tube lights, bulbs, more advanced air conditions. They can move towards energy saving. Fuel saving, especially in delivery. Pick and drop services. If they have moved towards electronic vehicles, they are moving towards fuel saving, environmental friendly. What else could be environmental KPIs for a hotel business? Wastage, waste control. Is that? If they are controlling waste, ultimately, this is what environmental friendly step. What else could be environmental friendly step from hotel point of view? Recycling, energy saving, fuel saving, waste control. What else could be? Saving the environment. Saving the environment. Grocery store, they can reduce the use of plastic baggage. My hotel, obviously, no. What else? Okay, let's see. Moving towards the question. So, new internal auditor Daisy Rose Spittle has recently joined Bluebell Company. She has been asked by management to establish and to monitor a variety of social and environmental KPIs. Obviously, this is the responsibility of internal auditor. They need to monitor whether companies are following policies or not. So company have set some social environmental KPIs, and internal auditor Daisy Rosepeter has been asked to verify whether company is meeting or not, complying or not. Daisy has no experience in this area. Okay. So we are the auditor. We know about these things. Okay, and has asked for ask you for some advice. Who are you? Who are you? Who are you? Is there any information about you? You are the manager responsible for the audit of global company. The requirement of this part is respond to partner's email. You have received this an email from partner. He is saying company has appointed new internal auditor whose responsibility is to monitor social environmental KPIs, and she doesn't have any experience in this area and has asked you for some advice, either partner or you. It has been agreed with global company's audit committee that you are to provide guidance to Daisy to help her in this part of her role. And you need to perform this extra responsibility. Extra services, obviously, will charge extra for that. Will charge extra for that. This is other than audit. And that this does not impair the objectivity of the audit. I mean, this will not be having conflict with the audit. You have just received the following email from the audit engagement partner on the Bluebell audit. To audit manager from partner regarding Bluebell company. Hello, I have a meeting with Daisy Hospital tomorrow. Who is saying? Your partner. For which I need you to prepare some briefing notes. To partner from audit manager. Subject, what he is asking for, date and introduction. Then our answer will start. There is a format for briefing paper. To partner from your manager. Subject, what he's asking for, date and introduction as per requested. I have highlighted this is this. So please prepare notes that recommend 8 KPIs which could be used to monitor Bluebell company's social and environmental performance. Okay, 8 KPIs we have identified. Social could be training of employees, equal employee opportunities, good working condition for the employees, free meals for the needy people, donation charities to the general public. And environmental KPIs could be recycling, energy saving, fuel saving, waste control. Okay. But not only the 8 KPIs, and outline the nature of evidence that should be available to provide assurance on the accuracy of the KPIs recommended. And for each KPI, what could be the evidence through which we are the internal auditor will be able to verify this is met. Not procedure, evidence, name of documents. For employee training of employees, what could be the procedure? Whether company have provided a training, how much they have provided training, inspection of payroll record or training expense to verify the amount of training provided by the company. So what could be the evidence? Copy of what? Payroll records.
Payroll report.
And training expense amount. Training expense account. Because that account copy we have kept in the working paper. Yes, sir. Employee equal opportunities company have provided. Through recruitment records, we can identify whether company have provided equal opportunities or not. So what will be the evidence? Copy of recruitment records. To verify number of gender mix employed by the company. Good working environment. How we can verify they have provided good working environment to the employees? through physical inspection of the area. If they have established a good canteen, we will physically inspect them. If they have installed some heating cooling system, we will physically inspect them. So during physical inspection, we have prepared notes. So notes of physical inspection. Notes of physical inspection of the area where improvements have been made. Is that? Free meals for needy people. How we can verify? Companies providing free meals to needy people. Through observation. Through observation. Observation is what? Action, procedure. So observation at the time when company is providing free meals to the needy people. To verify they have provided this. So what is evidence? Notes of observation. Or copy of records relating to. If they have prepared any records, how many meals we have provided during the years, copy of records of free meals. Through these records, copy will be able to identify how many free meals companies providing in any day. Donation charities. How we can verify company have provided donation charities? Records, donation account records, as well as cash book bank statement. If they have made any amounts to whom they have made from record, we can identify, and the amount they have paid, we can verify through cash book bank statement. Because if they are paying, they will not be paying cash, they will be paying through check, and the check will be withdrawn from the bank account. So records of donation and cash book / bank statement. If he has asked for procedure, that is easy. We need to explain in English how we can verify this. But writing down evidence is difficult. After procedure, what you will be having in your working paper. So regarding recycling, how we can verify? Company have used the recycled material rather than new material. Invoices of recycled material used. Because in invoice, the detail will be there whether what kind of material type was there that company have bought and company paid the amount. So invoices of the recycled material bought. How we can verify a company have save energy? Utility bills. So copy of utility bills. Current as well as previous. Because both will compare to verify whether they have been reduced or not. Number of units you consumed reduced or not. Fuel saving. Fuel invoices. We will compare with each other whether amount reduced or not. Waste control. How we can verify company have controlled the waste?
Physical inspection.
Of what area where
Yeah.
they are wasting things? How we can verify for complete year? This we can verify for one time only. Who is taking your waste? Waste dumping company. And they charge you according to the weight of the waste. How much is your waste? They charge you for that while collecting based on the weight of the waste. If your waste weight is more, they will charge you more. So we can Compare what? Invoices of waste dumping company. We'll compare current with the previous to verify whether the weight of the waste has reduced or not. Because they are charging you according to the weight. 50 kg multiplied by this rate is equal to this amount. If in next invoice 40 kg multiplied by this rate is equal to this amount, this means you have controlled. If in the next invoice it is a 70 kg while previous was 50, so you haven't controlled, you have even increase. Are you with me? So we are adopting an approach how to tackle this kind of question during the exam. So let's take a break. After break, we will discuss one more good question. Coming up in 15 minutes here. Okay, ECT AAA. Let's move towards one more good question. Very good question. Parker. Normally, this kind of question appear in the exam paper. Students are unable to complete their paper. Most of the students manage to attempt about 70 to 75% only. And if you have attempted 70 to 75%, it's very difficult to score 50 marks of passing this paper. Why students struggle? Because they are moving towards the exam without practicing this kind of question. The question we are going to cover after class, if you try to cover this question by yourself after covering during the class, it will take about 3 to 4 hours. But if you have practiced this during the exam, it will take about 90 to 100 minutes. 50 marks question, but will take more than half time of your paper. But we need to practice these kind of questions so that we can complete paper within time. Because to pass this paper, up to 90 marks attempt is necessary. If we have attempted below 90, the paper is on risk. So Parker question is there. There are requirements not at end of the question paper. It's between the question paper. If the requirements are between the question, we need to start reading from first word and move towards requirement, because there is some story behind the requirements. So you are an audit manager in Hound and Company. You are an audit manager in Hound and Company, responsible for the audit of Parker Company. So your client is Parker Company, a new audit client of your firm. Is there any issue if your client is new? Obviously, per ISA 510, we need to verify opening balances. Is there any issue relating to audit risk if your client is new? There is detection risk. If the client is new, due to lack of detailed knowledge about the client, auditor may not detect a misstatement. So there could be detection risk, but detection risk, we need to discuss if the requirement of the examiner is audit risk. The requirement is the risk of material misstatement. We don't need to discuss detection risk. So you are the audit manager in Hound and Company, and your audit client is a Parker Company. You are planning the audit of Parker Company's financial statements for the year ended 30th June 2023. Year end 30th June 2023. And you have just attended a meeting with Rath Kohli, the finance director of Parker Company, where she gave you the projected result for the year. Parker Company design and manufacture health and beauty products, including cosmetics. What our client does? They produce cosmetics. You have just received an email from Harry Shafford, the engagement partner. This is the rascal who is always behind you. If you are a manager, ultimately you are working under partner, and he's always behind you. So you have received an email from engagement partner. You are a manager. To audit manager from Harry Shafford, partner, subject Parker Company. Hello, I understand you met with Rath Kohli at Parker Company recently, and that you are planning the forthcoming audit. To bring me up to date on this new client, I would like you to use the information obtained in your meeting to prepare briefing notes for my use, in which you perform preliminary analytical procedures. Preliminary mean initial at planning stage. Analytical procedure mean comparing current year data with the previous year with budgets, ratio analysis. We need to perform analytical procedures. Why do we perform analytical procedure at planning stage? To highlight risky areas that we covered in previous question, like Bluebell. We compare the revenue increase by 25% while industry average showing 20%. So there could be chances revenue of this company overstated. because if industry average 20% and this company is operating in bad conditions, how they can achieve 25% more than industry average? So chances that revenue could be overstated. Like we covered one risk in previous Bluebell question relating to tax rate. Based on the tax expense, we compared with the profit and we calculated tax is 6.2%, which is too low. Unrealistic for a company. It should be about 25 to 30%. So company is understating tax expense and liability. So we need to perform analytical procedures. And these kind of questions are time consuming because we need to calculate ratios. And where calculations are involved, it's very difficult to cover the question within the allotted time scale. And evaluate the audit risk to be considered. Audit risk. Inherent, control, detection. Inherent, control, detection. If examiner is asking to evaluate risk of material misstatement, the previous two questions we covered on risk of material misstatement. Risk of material misstatement means inherent plus control. But every risk we need to link with the chance of misstatement. What could be overstatement, understatement, manipulation? In audit risk, what we will do? In the similar way we were identifying risk of material misstatement, we will perform the similar way. But at the end, we need to put a heading control risk where we will discuss some control risk separate. And we will put a heading of detection risk where we will discuss some detection risk separate. Inherent risk in the similar way that we have covered previous two questions. But at the end, we need to discuss some control risk and detection risk separate. Because now the requirement is audit risk rather than risk of material misstatement. So performing analytical procedure, we need to evaluate audit risk to be considered in planning the audit of the financial statement. And identify and explain any additional information that would be relevant to your evaluation. Not only we need to discuss risk, we need to identify and explain any additional information. What does mean by additional information? Name of document. The risk that we have discussed, what document we will see relating to that risk. At the planning stage, we need to provide the list of those documents as well. While stating audit evidence, we also mention the documents. This additional information is also document. But the evidence, the documents included in evidence are the documents that we have obtained after performing the procedure, where we perform the procedure during audit. Here we need to list down the documents along with each risk that we can see from client records at the planning stage, not during audit. Be careful. What documents at the planning stage you can see from client records relating to that matter. That we need to list out. And there are 24 good marks. In these 24 marks, 6 marks are relating to this additional information. And writing down one additional information, the name of document will be having half mark. And remaining 18 marks are relating to risk. If there are 18 marks for risk, 2 marks each risk, 9 good risk we need to identify. And along with each risk, we need to name the document addition information. We name the document relating to that matter that we can see at the planning stage. Okay. So what is part B? We don't know. So we will put a heading part A, audit risk. What we will do, whatever the issue we are finding, we'll put the heading like revenue, operating expense, deferred tax expense. We'll discuss the standard, We'll discuss the chance of misstatement the similar way we practiced the previous question. But at the end, we need to provide a control risk separate with the heading control risk, and we need to discuss detection risk separate. So moving towards question now. Obviously, we need to perform analytical procedure. In performing analytical procedure, we must be having a data about current year financial statements as well as previous year. And they have provided current year as well as previous year financial statements as well. And there is some other information as well regarding each account balance. So let's move towards performing analytical procedure. Revenue. Previous year it was 8,500, current year it is 7,800. Can you calculate how much percentage of revenue declined? 8.2%. 8.2%. And cost of sale also have reduced. By how much percentage? Can you calculate, please? 5680 minus 5,800 over 5,800 multiplied by 100. Current minus previous over previous multiplied by 100. 2.2%.
2.1%.
2.1%. Okay. GP margin can we calculate? GP over sale multiplied by 100 for both years. This is what ratio analysis. What is GP margin for current year 20x3? 2120 over 7,800 multiplied by 100. Twenty 27.2%. What was the previous year? 2,700 over 8,500 multiplied by 100. %, mean decrease. Okay, so company sale have decreased by 8.2%. If sale have decreased, there must be decrease in cost of sale. Whether with the same percentage or different percentage. Not same. Because if a company have sold lesser units, means sale have dropped down. Cost of sale will also drop down, but with lesser percentage, because only the variable cost will reduce, fixed cost will remain same. This means there should be more fall in revenue decrease as compared to fall in cost of sale decrease. If you see revenue has decreased by 8%, cost of sale have decreased by 2%, this is fair enough. Because the fall in revenue decrease should be more than the fall in cost of sale decrease. Is that? Okay. But there is a note one relating to cost of sale. What's note one saying? Cost of sale include 250,000 current year. Cost of sale include 250,000 relating to a provision for a potential fine payable. What is the accounting entry for provision? Debit expense, credit provision liability. 250. Where we record this expense? In cost of sale. If it is relating to fine payable, is that a fine having connection with cost of production? No. It should be operating expense rather than direct expense. If it is included in cost of sale, this is misclassified. Is that? That is understating the operating expense as well as overstating the direct expenses. The Advertising Regulatory Authority has issued a notice of 450,000 fine payable by Parker Company due to alleged inappropriate claims made in an advertisement campaign. And this fine is relating to wrong advertisement. And advertisement never ever is a direct expense, it is operating expense. And if the claim is 450,000, why you are recording provision for 250? The provision must also be 450,000. Is that? This means if you have recorded provision for 250 instead of 450, first provision is understated by 200. The fine is being disputed and the matter should be resolved in August 20X3. The current year is 30th June. If the matter will resolve in August 20X3 and fine is disputed as well, then might be it is not meeting the condition of provision. If it is not meeting the condition of provision, there must be contingent liability rather than provision. So there are so many issues. First, it is misclassified. Second, it is understated. And third, it is not clear whether it is meeting condition of provision because it is relating to future. So we'll put a heading provision. We'll put a heading provision. So first we will say the claim is for 450 and company have recorded provision for 250. So there is a difference of 200. There are chances expenses, liabilities could be understated by 200. Is that? Secondly, this provision is relating to inappropriate advertisement, which is an operating expense rather than direct expense. And if it is included in a cost of sale, chances that operating expenses cost of sale could be understated. Understated. Operating expenses understated, cost of sale overstated. Overstated. Is that? Then we will say per IAS 37, provision should be recorded if there is present legal constructive obligation from past event and probability of future economic outflow. And if the fine is disputed and the matter will resolve in the future, it's based on future event, then there must be contingent liability disclosure rather than provision. And if company recording provision rather than disclosing contingent liability, financial statement could be manipulated. Can we discuss these 2-3 points under the heading provision? But the matter is not resolved yet. We need to discuss additional information. So we'll put heading additional information under the subheading under this provision. What could be the document that we can see at planning stage relating to this matter? What could be the document that we can see at planning stage relating to this matter? Fine payable. This means fine payable, there could be any notice. So regulatory authority notice copy. Regulatory authority notice copy, from where we will be able to see what is the severity of the notice, how much is the involved, whether it is 450 or there are chances of 250 may reduced premium. So this is what additional information that we will see relating to this matter. And if the fine is disputed, this means there must be any communication between company and authority, because if it is disputed, there must be any communication. So we can say correspondence with regulatory authority. And these are the documents that we can see from client records at the planning stage we need to list down, not the document that we can verify during audit. Is that? Copy of written representation is evidence, not the additional information, because that we obtain during the audit after procedure. Is that? Copy of written representation is evidence, is a document, but that is after procedure we obtain from the management. What is the procedure? Obtain written representation from management relating to the matter. Copy of written representation is evidence, not the additional information. Additional information means relating to this matter, but a document we can see from client records that could be available at the planning stage. Be careful. Okay. So one issue we have discussed additional information relating to that issue. And about half of the student missed this additional information part. In out of 24 marks, they missed 6 marks straightforward. And after 24, to pass this part, you need 12 marks. In this paper, please keep in your mind, we are not going to pass the paper. We are going to get passing marks in each requirement. Out of this 24, how we should get 12 marks? If we are passing each requirement of the paper, passing paper will not be difficult. What students are doing, they are trying to pass the paper rather than passing each requirement. If you're not getting passing marks from each requirement, how you can pass the paper? No, you cannot. So you need to struggle how to get passing marks from each requirement. More than passing, in fact, not only passing, more than passing. And this passing this paper is not difficult. So moving further. So this was information relating to cost of sale they have given, and we know in this cost of sale 250,000 expense that is recorded wrongly. If we exclude this 250 from cost of sale, if we exclude this 250 from cost of sale, mean adding back this 250 to 7,800, then can you calculate how much percentage cost of sale has been decreased? If we add back 250 to 5680, it will become what? 5930. 5930. Is that? If we add 250 back to this, it will become 5930. Then can you check how much percentage this cost of sale has been decreased? Sorry, not adding back is we reduce this because this was added to this. If we reduce this, so this will become what? 5430. 5430 by deducting this 250 from cost of sale that has been wrongly added. Now if we see 543, yeah, minus 5800 over 5800 multiplied by 100, by how much this cost of sale has reduced? 6.8%. Which is almost aligned with the percentage of fall of revenue. Is that? Before, the difference between fall in revenue and fall in cost of sale was seem reasonable, logical. But now if we see 8% and about 7% decrease in cost of sale, this is not logical. Because the difference in revenue and cost of sale should be a little bit different, not aligned. Meaning the fall in revenue should be more than the fall in cost of sale. And if the fall in both is about a similar, aligned, there could be chances either sale could be overstated, might be there was more fall in sale above 8% and they have overstated to reduce this fall, or cost of sale could be understated. Is that? Now there is risk. Now we'll put a heading. We'll name it trading. Under this trading, first we will discuss the sale revenue. Fall is what? 6.8%. And cost of sale fall is what? 2.3% or 3.2%? 2.1%. 2.1%. While excluding that provision that was wrongly misclassified, the fall is what? 6.8%, 8.2%. This is 8.2%. And this is 6.8%, which is in line with the fall in sale revenue, which is unrealistic because only the variable cost is going to reduce rather than fixed cost. So chances that either sale could be overstated or cost of sale could be understated. And we can discuss GP margin as well. If we discuss about GP margin, previous year it was 31.8%. Current year it is 27.8%, mean the difference is only about 4%. While the revenue have decreased by 8%. While GP margin is not showing that much difference. So chances sale could be overstated or cost of sale understated. So we'll discuss this. What could be additional information for this? That most of the students missed during the exam. We'll say cost of sale calculation breakdown. Which will be able to find which cost has decreased, either variable cost has decreased, fixed cost has remained same, or that is also decreased, how that can be decreased. So cost of sale calculation breakdown, and we can say sale mix breakdown. Sale mix mean through sale mix we'll be able to identify which product sale has fallen, which product sale has increased, which product sale remain same. So we'll be able to identify so that we can compare with their cost, relevant cost as well. Mean cost of only those products should be reduced for which a sale has been reduced. If any of the product sale remains same, so their cost should remain same in cost of sale calculation as well. So this is what additional information relating to this matter. So two good risks we have discussed along with additional information. Now moving towards operating expenses. As the sale has decreased, operating expenses also decreased. Operating profit also decreased. If we look at finance cost, the previous year it was 125, current year it is 155 increase. Finance cost is charged on what? Interest bearing liabilities. Interest bearing liabilities mean where company is paying interest. We are having information about company balance sheet as well. Can you identify interest bearing liabilities? This preference shares is interest bearing liability. This bank loan is interest bearing liability. This finance lease is an interest bearing liability. This finance lease is interest bearing liability. This overdraft is interest bearing liability. Is that? Can you add all these 5 amounts? Can you add all these 5 amounts? What's the total? 3125 plus 3800 plus 4900 plus 860 plus 900. It's about 13,000 something.
13,585.
13,585. Okay, good. So I'm putting heading here what finance cost. The finance cost was how much? 155. Is that? Yes, 155. So 155. This is the cost calculated on 13,585 interest bearing liabilities. If we multiply by 100, can we find the interest rate? It's 1.2%.
1.14.
1.2%, 1%. Is that realistic? Interest rate could be 1%. You are having leases, you are having a bank loan, you are having bank overdraft. And bank overdraft always having interest rate above 25%. And in that you are having 2% preference shares, even their interest rate is 2%. If you have issued preference shares on 2%, how is it possible you can get a bank loan and leases below 2%? This means there could be chances. There could be chances. Finance cost could be understated and profit overstated. What we have done this, we have performed analytical procedure, ratio analysis, plausible relationship, and have discussed the risk. Either finance cost could be understated and profit overstated. What is additional information that half of the students will miss during the exam? What were the liabilities? See, liabilities. Preference share issue document through which we'll be able to identify what is the interest rate. Loan agreement through which we'll be able to identify what is the interest rate. Lease agreement through which we'll be able to identify what is the interest rate, and overdraft contract copy. So these all will be what additional information through which we'll be able to identify what is the interest rate. So preference shares, issue document, loan agreement, lease contract, and overdraft OD contract. This is the additional information through which we'll be able to identify what is the interest rate exactly that would have been charged. So moving forward. Profit before tax and taxation. Oh, yes. This 300 tax is calculated on this 1197. Can you calculate the tax rate? $300 over 1197 multiplied by 100. How much? 25%. Can you calculate tax rate for current year? 70 divided by 635 multiplied by 100.
9.5.
How much?
9.5.
9.5. 70 divided by 735.
Yeah, 70 divided by 735 into 100.
9.5%. In previous year, you paid a tax based on 25% rate. That is realistic for a company. But in current year, you are paying tax about 9.5%. How comes? Is that possible? This means there are chances tax expense as well as tax liability could be understated. So we'll put the heading what? Taxation. And we will say previous year tax rate was 25%, while current year tax rate is 9.5%, which is unrealistic. So chances that either tax expense and tax liabilities could be understated. What is additional information? From where we tax return copy? From where we can identify tax rate? Tax rate copy. Tax rate HMRC. HMRC tax rate copy. You can say HMRC because we are still in UK. So HMRC tax rate documents, which will be able to identify what is the tax rate for a company. Or you can say instead of HMRC tax rate, copy what's the document that they change every year regarding tax, financial year, tax year. The name of that document on which they change the tax rate every year. Okay, see, HMRC tax rate documents. So moving forward, how many risks we have identified relating to provision? We have discussed one risk. Relating to trading, we have discussed one risk. Relating to finance cost, relating to taxation. Moving forward, because we need to perform analytical procedure and then risk we need to discuss. So P&L is completed here. So moving towards balance sheet data. If we discuss at property, plant and equipment, it has been increased as compared to previous year by 2100. Is that? Intangible assets, development cost, not in previous year, current year, it is showing double to 50. There is note 2 as well. If we see other things, what is inventory has increased, trade receivables slightly increased, cash balance was 1000 in previous year, current year companies having 900 bank overdraft, they don't have cash. They are struggling. They are living on bank overdraft. They don't have cash in hand. Okay. Share capital same, the valuation reserve has increased by 500. Retained earning decreased because company profit has decreased and preference share same, bank loan have increased. You are struggling in cash. And finance lease has increased. Trade payables increase. You are struggling. Taxation, you have shown 70 here. But you are showing 50 in liability. How come? So this we can discuss here in taxation. Like tax expense is a 70 while liability is a 50. So chances that by 20 liabilities are also liabilities could be understated. Is that? Okay. Moving forward. So there is a development cost asset given and there is a note 2 on that. The development costs related to a new range of organic cosmetics. Development costs should be capitalized per IAS 38 by meeting a certain criteria. And that criteria also include what commercial viability, technical feasibility, availability of resources, including financial resources as well. Do you have financial resources to develop this 2250 development cost? And if company capitalizing without meeting criteria, chances that asset profit could be overstated expenses, understated, so we'll put a heading development cost. I'm moving here. We'll put a heading up, discuss standard IAS 38 development cost could be capitalized using certain criteria, including the technical feasibility, commercial viability, as well as availability of resources. And currently companies are having a bank overdraft of 900. They don't have financial resources to develop this. Even after developing this, you need to launch in the market, and launching will also require finance that you does not have. And if company capitalizing without meeting the above criteria, chances that asset profit could be overstated, expenses understated. What could be additional information for that? Cash flow forecast, through which we will be able to identify whether companies are having cash resources or not. Is that? There will be some more information about this that we will discuss later on. It's not completed yet to admin cost. Okay, now there is a note 3 as well. Inventory, trade receivables, cash, equity, revaluation reserve. Note 3, 500 has increased. All of the company's properties were revalued on 1st January 2023, 6 months before year end, by an independent professionally qualified expert. That's why this 500 is what revaluation gain. If there is a revaluation gain of 500, assets should be up by 500. While if we see in the asset, it has been increased by 2100. We'll put a heading revaluation. Revaluation. For IAS 16, company can revalue their asset, but all asset in the same class should be revalued. No selective valuation is allowed. And asset should be depreciated over revalued amount. Revaluation gain should be charged to revaluation surplus and losses should be charged to P&L. The revaluation surplus showing 500 increase, while assets showing 2100 increase. If there is no other addition to the asset during the year, chances that either asset has not been depreciated over the revalued amount, or losses, revaluation losses could also be charged to revaluation surplus. Might be there was 2100 gain and the losses they have also adjusted with the valuation surplus. That's why valuation surplus showing only 500 change and the asset showing 2100 change. Is that? In fact, if we see if there were any losses on some of the asset, there was gain on some of the asset, the change in revaluation surplus should be more than the change in asset. Because to asset, we need to record the losses as well. But here the things are reverse. So either asset has not been depreciated over the revalued amount, or the losses has also been adjusted to the revaluation surplus rather than charging the P&L. Chances that financial statement could be manipulated. Is that? What is the additional information for this? They is saying who performed the revaluation? Independent professionally qualified expert. So who will report the expert report? Expert valuation report, through which we'll be able to identify how much is the revaluation gain, how much was the loss, where there was gain, where there was loss, and then we will see where they have charged property. Is that? Or we can say company policy document as well, through which we'll be able to identify whether company is having a policy of revaluation or not. Okay, moving forward. So we have discussed almost everything. There are 24 marks. Analytical procedures. Now I'll put a heading, one more heading. We will say it liquidity. Analytical procedure also include ratio analysis as well. Here we will discuss current ratio of current year with the previous year. We will discuss quick ratio of current year with the previous year. And we will discuss the cash balance as well. That was 1000 positive and current year company is having 900 overdraft. And if we see the current ratio also decreased, quick ratio also decreased, even the cash balance has also decreased. This means company is having serious cash flow issues which may not be disclosed properly in the financial statements for IAS 1. Is that? What is the additional information for that? Whether company is having cash flow issue or not. Because if it's having, there must be a disclosure. If they don't have, no need for disclosure. Cash flow forecast. through which we will be able to identify whether company is having cash flow issue or not. Is that? After that, we'll put one more heading called insolvency ratio analysis, analytical procedure. We'll compare gearing of current year with previous year. And while comparing gearing ratio debt over equity, it has been decreased as compared to previous year. We can discuss interest cover, interest over profit before interest and tax. It also decreased. And it also showing a company is having a serious problem to continue, which must be disclosed in the financial statements per IAS 1. And additional information for this will be the same. We don't need to repeat. Now we'll be able to cover 24 marks. In this type of question, one risk is not for 2 marks. It could be more than 2 marks. Like here, we have discussed about sales, we have discussed about cost of sale, we have discussed about GP margin as well. So it could be 3 marks rather than 2. And if we see addition information 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, at least 12 addition information we need to discuss in all the risk for 6 marks, because one additional information is having half mark. Control and detection is still left. Let's see. Here's other information. Notes from your meeting with Rath Kohli. Parker company is facing a difficult trading condition that we have already discussed in liquidity. Consumer spending is depressed due to recession in the economy. There is a recession. If there is a recession, commercial viability of your new development product will also be affected. Is that? This we can link in development cost as well. The health and beauty markets remain very competitive. If there is a high competition, it is very difficult to successfully launch the new product. And a major competitor launched a very successful new cosmetic range during the year. If they have launched before you and captured the whole market, how you can sell your new product? Commercial viability is affected, which led to a significant decline in sale of one of Parker company's most successful brand. Even your brand image is down. It has been necessary to cut the prices on some of the company's product range in attempt to maintain market share. You are losing your market share as well. There is no commercial viability for new products as well. However, a new brand using organic ingredients is being developed, is due to launch in September 2023. But your market has already been captured by the competitor. So this commercial viability we will discuss under development cost. It is not meeting commercial viability, not only resources, financial resources, it is not meeting the commercial viability as well. Financial matters. Cash flow has been a problem this year. Yes, we have seen. Largely due to cash spent on developing new product range. You are struggling. You don't have cash. Cash was also needed to pay dividend to both equity and preference shareholder. Oh my God. Not pay a dividend to a shareholder. They will try to withdraw their investment. And if they will withdraw their investment, you will not be able to survive. Is that? Preference shareholder to whom you need to pay a fixed 2%. You don't have cash to pay them. What you will do? Company survival is difficult. To help to reduce cash flows, some new assets were acquired under finance lease and an extension to company's bank loan was negotiated. You are trying to extend the loan. You are not in a position to repay back. In December 2022, after 6 months of the year end. So company is in dire state. Company is in dire straits. Dire straits mean in very bad financial situation. Human resource. In December 2022, Parker Company's internal audit team performed a review of the operation of controls over the processing of overtime payments in the HR department. Their review found that the company's specified internal control procedure in relation to processing of overtime payments and associated tax payments were not always being followed. Control weaknesses. If controls are not being followed in your payments, in your tax payments, chances that misstatement may not be prevented, detected, corrected by the system. If we are discussing control risk under risk of material misstatement, each control risk we need to discuss regarding a chance of misstatement in financial statement, overstatement, understatement, manipulation. I mean, if we want to discuss this, if the controls on overtime payments as well as tax payments are not being properly followed, chances of manipulation in financial statement. But now we will discuss if the controls on overtime payments and tax payments are not being properly followed, chances that misstatements may not be prevented, detected, corrected by the system. Until December 2022, this processing was split between the human resource and finance department. Since then, the processing has been entirely carried out by the finance department. I mean, there is no segregation of duty control as well. And due to lack of segregation of duty, misstatement may not be prevented, detected, corrected by the system where we will discuss under here. Detection risk we have already found in very first line. Parker is a new audit client. So due to lack of detailed knowledge about client business, auditor may not detect misstatement. Picture haven't finished yet. Expansion plan. Expansion plan. We have covered requirement A almost for 24 marks. Requirement B. Discuss any ethical issues raised and recommend the relevant actions to be taken by our firm for 7 marks. I mean, ethical and other professional issue question could be tested in this type of question as well. And in this paper, it was tested 7 marks with this question, and there was about 16 marks separate question as well. So ethical and other professional issues we need to discuss. Expansion plan. Management of Parker Company is planning to expand Parker Company's operation into a new market relating to beauty salon. Before they were producing cosmetics products, beauty products. Now they are moving towards beauty salon as well. Why? Because their product market is destroying by the competitor. So now they are deciding to open salon business as well. So that in salon, at least we can use our products. This is a growing market. Okay, and there is synergy, extra benefit. If we are not selling products outside, at least we can sell in our salon. Is that mean our revenue will be fixed internally within the business? Because Parker Company's products can be sold and used in the salons. Expansion would be through the acquisition of an existing company which operates beauty salon. A potential target beauty boost company have been identified and preliminary discussion have taken place between the management of the two companies. Is there any issue for us? No. They are going to expand their business, how they are going to enter into salon, how they are opening salon, they are acquiring already existing salon business. Okay. Parker Company's managing director has asked for our firm's advice about the potential acquisition. Oh yes, advisory services to audit client, create advocacy threat. And if the advisory is relating to the acquisition, relating to any amount that they are going to invest, and that amount will become any account balance in the financial statement that we need to audit afterward. So we'll create self-review threat as well. Is that? If our firm is having separate advisory department, we can continue these extra services, but through Chinese walls, i.e. separate staff for audit, separate staff for advisory services. One issue, two risk we have discussed for 3 marks. Okay. And specifically regarding the financing of the transaction. Obviously, if we are advising about finance, that finance will become account balance. Beauty Boost company is an audit client of our firm. So we have a considerable knowledge of its business. That target company that they are going to acquire, against which they require our advice, that target companies are audit client. Conflict of interest. We are having confidential information about that company against which we are providing advice. Is that will create what? Self-interest threat. What we should do? We should maintain separate staff, Chinese walls. Staff for advisory and for Beauty Boost should be from different offices. And we should inform both the client, especially Beauty Boost, like we are having your confidential information that we will maintain by arranging separate staff. If they agree, we should continue both. If there is any allegation from Beauty Boost, either we should resign from audit of Beauty Boost and accept this advisory. Or if we want to continue audit of Beauty Boost, we should reject this advisory services against our client. This will be having 4 marks because there are so many actions we need to discuss. This will be having 3 marks because we have discussed 2 risks or 2 threats. And for both the threat, there is only one action, separate staff. 7 good marks. It's a very good question for practice. What you need to do, you need to read the answer of this question either today or tomorrow. We are having class tomorrow as well. Good news is that we are having class tomorrow as well, 2:30 to 5:30. But before that class, what I want is very difficult, but you need to attempt this question before next class. Please, if you want to pass this paper in this attempt, please. See you tomorrow, 2:30 to 5:30.
Okay, sir. Thank you.